WTI's upward movement last week appears to have been interrupted, with the movement of the commodities price action appearing to be moving in a downwards fashion since the beginning of the week, in an indication of the sensitivity of the oil market to its fundamentals. In today's report, we have a look at the situation in the Middle East, the IEA's report, and the state of the US oil market. The report is to be concluded with a technical analysis of WTI's daily chart. Tensions in the Middle East remain elevated, yet the situation appears to have subsided to some degree. In particular, we would like to reference the recent report from the US government that they have received assurances from Israeli officials that no Iranian oil and nuclear facilities would be attacked during their widely anticipated retaliatory strike. In turn, the alleged assurances from Israeli officials to the US tend to have dampened market worries about a potential shortage in supply stemming from Iranian oil facilities and that the global oil trade may not be interrupted. Therefore, the apparent willingness from Israel to refrain from escalating the situation even further may have weighed on oil prices. However, recent reports have emerged that Israel's plan to strike against Iran is ready, and thus should Israel renege on the alleged promises and decide to strike oil facilities or even Iranian nuclear facilities, the possibility of a regional war may be intensified, which may send oil prices roaring higher. Nevertheless, Iran has vowed to retaliate against any future Israel strike, which could escalate tensions regardless of their targets Israel may decide to strike, although we would not be surprised if the comments are simply posturing from the Iranian side in order to save face. In conclusion, should tensions in the region subside, we may see reduced possibility of a regional war weighing on oil prices. Whereas should tensions escalate with the possibility of a regional war increasing, it may aid on oil prices. The IEA has released its October oil market report for 2024, in which the IEA states that China underpins the deceleration in growth, accounting for around 20% of global gains both this year and the next year, compared to almost 70% in 2023. Moreover, the IEA stated in the same report that they stand ready to act if necessary, and that in the absence of a major disruption, the market is faced with a sizable surplus in the new year. Overall, the IEA report tends to paint a picture of a reduction of oil demand stemming from China, which in combination with adequate oil supplies may weigh on the liquids gold price. WTI appears to be moving in a downwards fashion after breaking below our support turned to resistance at the 71.50 level. We opt for a bearish outlook for the commodity, and supporting our case is the RSI indicator below our chart, which has broken below the reading of 50 and currently registers a figure near 40, implying a bearish market sentiment. For our bearish outlook to continue, we would require a clear break below the 64.75 support level, with the next possible target for the bears being the 57.30 support line. On the flip side, for a sideways bias, we would require the commodities price to remain confined between the 64.75 support level and the 71.50 resistance line. Lastly, for a bullish outlook, we would require a clear break above the 71.50 resistance line, with the next possible target for the bulls being the 78.0 resistance level. Thank you for joining us today as we navigated through the dynamic world of financial news. From all of us here at IronFX, we wish you a